So you're interested in buying commercial real estate but don't have the money to get started? Well, don't wait to become an investor. I'm going to show you 5 ways to buy property without a dollar out of your pocket and 3 of my favorite ways to creatively structure deals so that you need as little money as possible. I'm Tyler Cobble, and welcome back to my channel where each week we're sharing videos with you on commercial real estate investment strategies, leasing and management tips, market updates, and more. Investing in commercial real estate can be very lucrative. Not only do you benefit from passive income through cash flow, but you also receive many other benefits, such as tax write-offs and appreciation in value. However, there's one pretty big problem with these investments. You need money, and lots of it. Unlike stocks and bonds, you can't just invest with as little as a few $100s, unless of course you're taking the crowdfunding approach. For good deals, you'll likely have to come out of pocket hundreds of thousands, if not millions of dollars. But there are a few ways to get around that issue. Here's how to buy commercial real estate with no money down. No, you don't necessarily need money. That's right, there are ways of getting around needing a down payment. If you want to acquire commercial property but are running a bit low on funds, you still have some options. But unless you get creative, you may need some money down. Just about any lender will want to see you, as the borrower, have some skin in the game, which does make sense if you put yourself in their shoes. If they're going to give you that much capital to help you purchase a property and make any tenant improvements necessary, they don't want it to be easy for you to simply walk away when things get tough. Lenders look at these investments from a risk management perspective. The down payment is often a lender's spread in the deal should everything go south. So the traditional bank approach likely won't work if you're trying to come out of pocket as little as possible. That means let's get creative. Here are a few options for investing in commercial property where you could potentially put no money down to acquire the project. Sure, these methods may not be the easiest and certainly not the most convenient, but they can be an excellent way to start building your portfolio before you have any money. Up first, rent to own. Starting off with a lease on the property prior to purchasing it can actually be beneficial for both you and the seller. Leasing will give you a chance to test the waters and make sure that the building and location will be right for you while decreasing your overall risk exposure. The seller will also collect rent each month, which most landlords won't be upset about. Here's how you could approach a rent to own scenario. First, you decide upon an appropriate monthly rental rate and any tenant improvements, just as if you were negotiating a normal lease. Then you pre-negotiate with the landlord how much of the rent will apply towards the purchase when you do decide to exercise a purchase option and what that purchase price will be. Next, you'll set a timeline as to when you can exercise that purchase option, which I've typically seen in a 3 to 7 year time period. Now, if at the end of that window you decide not to purchase the property, all you've done is lease the space. However, if you do decide to move forward with a purchase, the seller will typically credit you a portion of the rent payments at closing, which could be applied towards your down payment. If you have any issues with finding a local bank or lender to loan out the money at the acquisition, you could always use one of my later methods, seller financing, in combination with rent to own. Up next, we have the SBA 7A loan. If you own a small business, the SBA 7A loan may be the best path for you to take. Certain lenders are offering financing up to 100% of the loan for qualifying business owners. So you'll want to reach out to the top local SBA lenders in your area to see if this program is within their company initiatives. Businesses that could potentially qualify for this loan program must have a significant amount of collateral, a debt service coverage ratio or DSCR of 1.25 or higher, a track record of positive cash flow and stability, a 51% occupancy of the property or higher, and outstanding personal and business credit. So there is certainly a catch there. If you take this loan route, your business will have to occupy the majority of the property in order for you to qualify. However, you could use the SBA 7A loan just to get started and eventually refinance the property once you've built up enough equity and transition it into a full-time investment. Next is seller financing. As I mentioned earlier, you could explore a seller financing option. Seller financing means exactly as it sounds. The seller, instead of a bank or local lender, will finance your acquisition of the property. Essentially, they'll hold the note on the property and retain the mortgage while you make the loan payments to them. Seller financing is a good option option for buyers with credit issues as well, because sellers often won't perform the extensive background and credit checks like a traditional lender would. Now, keep in mind that while you may not necessarily be coming out of pocket for a down payment, you likely have to pay above market interest rates or agree upon a higher purchase price in order to make the seller comfortable with a 0% down payment. However, if seller financing does help you acquire the property, it may be worth it. When pitching this offer to a seller, be sure to highlight the fact that they will retain the first position mortgage on the property, so they could always foreclose on you and take the property back if they have to. Hopefully that's a worst case scenario, but it could help you make the seller comfortable with this process. Projects with seller financing will often have a 5 to 7 year balloon, which means the loan will come due and need to be paid off in full. At this point, you'll simply refinance the property and pay the seller off. You could, of course, refinance the property at any time before that balloon in order to find better terms with a traditional lender if you've built up enough equity in the property. And here's a pro tip. If you want to keep your monthly payments as low as possible, I recommend trying to negotiate a 30-year amortization. One thing to keep in mind though is that you won't have as much equity built up in the property when you go to refinance as you would if you did a 20 or 25-year amortization. My next method is to have the seller credit the down payment. This acquisition method is one of my favorites and certainly among the most creative, but you do have to be very careful with how you approach the seller crediting the down payment scenario. You'll want to be very upfront with your lender so that they're aware of how the down payment is being paid. Many lenders often won't like that you, as the buyer, aren't the one coming out of pocket for that equity portion. However, I've found that lenders may be willing to work with you in this case, especially if you have a strong pre-existing relationship. When working with the seller, you'll also have to show them how helping you with the down payment is beneficial for them. Now, what I typically see is that the overall purchase price is raised to cover the costs so that the seller doesn't have to necessarily come out of pocket to help. If necessary, you can raise it a bit more so that the seller ends up profiting more off of the sale, therefore incentivizing them to work with you, because doing so is obviously going to be more complicated than a traditional sale. One thing to be aware of when increasing that acquisition price is that the property will still have to appraise in order for a lender to feel comfortable giving you the capital to take it down. Now, depending on the current state of the property, this assistance could also be categorized as a repair allowance and credited to you at closing for making necessary repairs and maintenance to the building. Again, transparency with all properties is critical here so that you don't find yourself in a legal bind. Next is Subject to. Subject to acquisitions became very popular during the Great Recession when property owners just wanted relief from the expenses of owning and maintaining their site. If your seller is in a bind and needs to move quickly, you may be able to purchase their site subject to the existing mortgage, which essentially means that you're assuming their note and taking on the liability and expenses that come with it. Again, you'll have to find a very specific seller that is in dire straits and simply wants to walk away from the property. You'll want to check with the lender and read the loan documents as well to make sure that the loan is assumable, because if it isn't, then the note will be called as soon as the deed is transferred to you, which could put you and the seller in a very bad position. Buying property subject to is an excellent way to help out a distressed seller while moving quickly on an investment. Now, I'm sure by this point you've realized that true no money down methods can be somewhat undesirable in some respects, and honestly just tough to pull off. In case you need a backup plan, here are a few of my favorite little to no money down options. Up first, get your real estate license. Having my real estate license was the best way for me to get started buying commercial properties before I had any money. There are certainly pros and cons to having your real estate license, but your ability to negotiate a commission on the purchase of a building is very high on that pros list. The first office building I acquired actually started out as an investment for a client of mine. They were going to buy it and move their company into the space, but when financing fell through, I had them assign the purchase and sale agreement to me. I then approached two investors, pitched them on my plans for the site, and asked them for $50,000 each. I then rolled in my 3% commission, which became 15% equity in the project, and then took another 10% equity for finding the investment and managing the asset. By having my real estate license, I've since acquired 4 more properties using this strategy and having little to no money technically out of pocket. And that brings me to my next method, which is to just bring the opportunity to investors. If you don't have the cash, but you know people that do, bring them into your deals. Investors like to get a return on their money and need opportunities in order to do that. If you can put in the sweat equity into the project by finding the deal and putting the plans together, investors may be willing to place capital with you. If you don't want to come out of pocket for any expenses, you'll likely be giving the lion's share of the equity to the investors, but that could still be advantageous for you since it gets you involved in the deal and you'll start building your track record. Similar to the last method of getting your real estate license, you could set aside a portion of the equity for yourself for finding the deal and putting everything together. Next, you could buy vacant property and lease it prior to the closing. I recently used this method to acquire a retail project in East Nashville. We put the building under contract while it was vacant, and our local lending partners were expecting a 20 to 25% down payment due to the risk of no income. However, while it was under contract, my team and I worked to find a tenant for the building and ended up getting a lease executed prior to closing, which then allowed the lenders to value the property based on the income from the lease and not just the attributes of the property. We were then able to secure financing with a 90% loan to cost due to the high appraisal, which meant that we came out of pocket less than half of what we were anticipating going into the deal. So now that you know how to buy commercial deals with little or no money down, check out this playlist here with more tips on getting started in commercial real estate, and I'll see you in the next video.